Hey everyone, I hope you had a good weekend. I know the market has been tough lately. We normally do these no-huddle market updates when the market's basically going haywire, and it doesn't happen very often. But at this point, I know it's only been a month since I've done one of these, but I'm out of town right now at a conference in San Francisco. I was just actually speaking at the conference 2 days ago, and it's been a great opportunity to talk to a bunch of my friends in the industry. All we did for pretty much the last few days is discuss the markets, the economy, potential market crashes, recessions, and so on. Aside from that, I just felt that after the last week, especially, it made a lot of sense to send you out another video with a little bit not only about what's going on in the market and maybe some probabilities or possibilities, but I also wanted to tell you a little bit about what we're doing for you. If you're a client, I should say, what we're doing in our model portfolios, what's changed over the last month and a half, 2 months, and again, what might lie ahead. So, with that, I always start with a quote. The late Bill Dunn, an entrepreneur trader, he said, "The market is a battlefield and you have to be ready for the fight. So you must be prepared for the fight." And that's, one of those things where recency bias as a human is something that, we fall victim to. And that means that, when the market starts doing well for a while, we start getting used to things going well. And then all of a sudden something happens. And obviously we all know what's happened here with the tariffs and, all the things that are going on in the market that are causing it to struggle. So, second of all, I wanted to jump, like I said, right into what we've been doing with our portfolio models. We have two different strategies at our office. The first, most people are probably used to if you're not a client, but if you're a client, of course, you know that we have strategic models. The word strategic starts with an S, so does the word static. That's how we remember they stay in the market. So strategic, static, stay. So our strategic models, which most of our clients own at least a percentage of, whether it's 25%, 50%. Some people have all strategic models, but all of those strategic models are invested 100% to target. And what that means is strategic models, again, they stay in the market based on their risk profile. So if they're aggressive, they're going to have more stocks, more commodities, let's say. If they're more conservative, they're going to have more T-bills, bonds, maybe even cash, in an environment like this. But that's how the strategic models work. And I put a little note there that half the bond allocation that we currently have invested in the strategic models is actually invested in short-term T-bills at this point, because even positions like convertible bonds, high-yield bonds, they've been really struggling and been hit pretty hard as a result of the tariffs. And so it was time to take things a little bit even more conservative. So bottom line, the strategic models, they stay in the market, they rotate out of weakness into strength. So in other words, what's inside the pie chart changes, the investments we own change from, offensive sectors to defensive sectors. So what we own changes using that kind of stay with the playoff teams and avoid the rest philosophy, but they do stay invested to target. On the other hand, the tactical models, tactical starts with a T. So does trend following. So that's how we remember what tactical means. At our office, again, we have two strategies. So one's strategic, the other one's tactical. So the trend following models are currently invested anywhere between 72 and 94% in short-term bonds, TIPS, and T-bills. TIPS are just Treasury inflation protected securities. And said another way, if we flip it on its head, those models are only invested at about 6 to 28% in stocks. So we've been scaling out of the market going back 6 weeks at this point. There's a couple times where we tried to dip back in and buy, trade up is what it's called. So buy back into the market with a couple positions, a couple stocks, and it didn't work out, and we've had to get right back out of them again. So basically these tactical models, the way it works is they are not trend prediction models. They are trend following models. There's no such thing as trend prediction. So what we're doing is we're following the market. We're letting the market tell us what to do. And as the market starts to fall, we sell on the way down the hill with any investment we might own in these models. And when the market bottoms, we want to buy on the way back up the hill when things start to look a little bit sunnier and the landscape looks a little bit safer to invest. So the point of having two strategies, just briefly, and as a reminder to our clients, is that there's times when the market goes down fast and up fast. And because we don't know yet, this could be one of those markets where the market went down fast and it's going to come back up fast. And if it does, the tactical trend following models will probably lag. In other words, we will probably see underperformance from the trend following models because it might take too long, even though we always do our best to get back in as early as possible, understanding we have to make sure that there's a true trend in place before we can buy back in. But sometimes we have to buy back in higher in order to allow these trend following models to work. And what I mean by that is if this turns into a grinding big bear market crash, then those tactical trend following models are going to shine because they will have already been out of the market if this thing continues down over the next month, quarter, or through the rest of the year. So in other words, if the market continues down through the rest of the year, the trend following models do great. And the strategic models will struggle. But if the tactical and trend following models don't do well because the market comes back really, really fast over the next month or two, then those strategic models will be nice to have had because we'll have a portion of our money that stays invested not only in the market, but it stays invested with, again, the playoff teams. So again, picture all the investments we could own being in the March Madness tournament. We don't want to invest in all the investments. We want to invest in the top seeded teams, the top ranked teams, and avoid the rest, and then stay invested in those top seeded teams as the tournament, or in other words, as the market moves along here. So obviously, changing gears, this just kind of lightened the mood a little bit. Somebody shared this cartoon. I thought it was great. I think it was Arun on Twitter, or it's X now, I guess it's called. But Camper says, and then everyone started tariffing each other. And I think that's pretty much what's going on. Fundamentally, technically though, when we look at price analysis, we've got the market today. I had to use stockcharts.com because I wanted to see intraday activity here. But this is a weekly chart. Market kind of went down. This first red line here, that first red line was kind of the first line of defense that would indicate we're still in an uptrend. Well, as soon as we broke through that line last week, then all of a sudden the uptrend was obviously violated, and we find ourselves in at least a trendless environment, if not a downtrend. So now we've got the second line of defense here, which was the spring highs of 2024. That line was violated. So now we find ourselves in what I would call the danger zone, which I'll show you in a second. But the good news is the first line of defense would be a potential floor of support below our feet, which are represented by the spring lows of 2024. And it looks like so far anyway, the market opened today, that's Monday, April 7th, I'm recording this, the market opened today right at that level. It traded down below it, and so far it's trading above it, and the market is rallying. But we're going to have to see how this goes. This is one day. Each one of these candles is 1 week, so this is just the first day of this week, and it's way, way too early to be calling the coast clear. So, but right now, again, this is a probability based analysis. We're looking at the weight of the evidence, and what we're trying to do is figure out, okay, when are things going to bottom out here, and then when is the coast clear? And again, right now it's not looking that way. It's way too early. However, if I were to draw another line going all the way back here to 2022 in January, you could see if you draw your eyes over just below that potential floor of support is actually right below where the market traded down to today. So in other words, the 2022 highs, 2021 highs is also an additional potential floor of support as well. So just keep that in mind. This is my inverse traffic light. It's really hard to see the candles down here because of the colors, but basically, again, I mentioned we were in this caution zone. This is a daily chart, by the way, so every candle is a day. The market gapped down in the caution zone. It gapped down again really, really poorly last week, and now we find ourselves in the danger zone, which again is marked by last year's spring highs and then the lows from summer of last year. So that's where that line comes from. So again, it's going to be a waiting game today at this point to kind of see how things work out over the next several days. But let me change my tone here. That's what's going on. So I'm reporting the news here. I'm sharing with you the analysis of what's going on and what's happening and kind of where the levels might be that we need to be watching. But now let's talk about some, more evidence, but some positive evidence. This is the VIX at the bottom, the volatility index. The volatility index measures fear. In other words, the lower this index is, the lower the fear. The higher the index is, the higher the fear. There have only been 6 times before last week that the VIX spiked above 40. And when you look at those past 6 times, when we were in a bear market, so in other words, during 2000, 2001, 2002, or during 2007, 8, and 9, the 3 times the VIX crossed above 40, the market was not ready to bottom yet. It was basically there was still either weeks or months. In the case of 2002 here, or 2001, it was more than a year before the market bottom. So when half the time when it happens, it's not marking the bottom. You've got some time to go. But if in the times when we've been in kind of an uptrend here, which if you looked at a really ultra long-term perspective, you might argue that we're still in an ultra long-term mega trend going back to the 2009 lows. And if that's the case, the other three times that this happened, it marked very close to, if not the low. Like COVID, for instance, was obviously a very news-driven, emotional time when all businesses got shut down. Things were closed down. Nobody could go outside. We couldn't spend time with our family, our friends. And the market went down. The VIX spiked above 40. And by the way, I believe today it was above 60, which it did during COVID as well. So I'm literally recording this at almost noon Eastern. I'm in Pacific time right now. But at a similar type of event, different things going on. Obviously, today it's tariffs, then it was COVID. The VIX spiked very high, and it marked the bottom of the market. Is that going to happen now? I have no idea, but this is something I'm paying attention to, because we have to take things day by day. We have to be objective, and we can't just look at things in the news and just assume that we should just, the sky's falling and we should throw our hands up and give up. We have to be paying attention. Speaking of news and reasons to ignore it, when you look at the last time, speaking of the VIX again, the last time we've seen huge weekly spikes in the VIX, and then going back to 1990, so this is January 1990 to April of 2025, you can see here the VIX spike this time around was 109%, which is the third biggest spike in the last 15 years. I'm sorry, 15 years, in the last 35 years. And when you look at the forward-looking returns, other times when this has happened, obviously there's some years like 2007, right at the beginning of the bear market, the Great Recession, returns were not good over the next 1 and 2 years. If you can go back to, let's see here, 2021, it was down 11% over the next year, down 7.3% in 2018. So there's a few times in here where the market was down. But when you look at a lot of the big ones, the top 5, let's just say, the returns are extremely high over the next 1, 2, 3, 4, and 5 years. And when you look at the averages down here at the bottom, we're talking about 11, 23, 46, and so on. Secondly, when you look at the highest VIX closes, this is weekly closes, and then forward-looking returns going back to 1990, you can see here this ranks only way down here at the bottom. It's not even, this is 45. Obviously, today we're probably going to be looking at something above 60, so there's going to be a new stat surely that comes out here after the close today. But bottom line, when you look at all of the VIX closes above, or I should say highly weekly VIX closes and the forward-looking returns, they're all green, all of them. So you can look at the averages. You can look at the 1, 2, 3, 4, and 5 year for every one of these big VIX spikes. But what this is telling us, psychologically speaking, and we're looking at behavioral finance here, is that when the fear gauge jumps really high and people really freak out, whether it's for good reason or not, it does not matter. The statistics say that when the fear gauge jumps really, really high, it's typically a good time to look at potentially taking more risk in your portfolio going forward. So that doesn't mean invest a bunch of cash today. It doesn't mean that you should have been invested 100% last week. I already mentioned our trend following models are, heavily invested in cash, but because they follow the trend, they don't predict the trend. And the strategic models are 100% invested. But if you have a strategy or multiple strategies like we do at our office, all I'm saying is that it might be a good time to be ready to pull the trigger, I guess. Let's put it that way. One more, I'm probably going overkill here. But this looks at the biggest 2-day declines and forward-looking returns going back to 1950. So the biggest 2-day declines, the worst one was Black Monday. You can see here. Excuse me. So Black Monday, 1987, 24.6%. Same thing, Black Monday here again, 16.2%. Then COVID, 13.9%. 2008, during the Great Recession, 12.4%. And then this. So this is what we have here. And then when you look at, again, the forward-looking churns over the next 1, 3, and 5 years, they're all good. They're all positive. It's 100% win rate and very high. Now, does that mean that this market has to go up from here and that it definitely is going to be up a year from now? No, it doesn't. Here you can see the worst 1-year return here was during the Great Recession. There was a 9.4% drop in 2 days, and the market was only up 9% a year later. So it could be something like that, a single-digit return. It could be negative. It's always positive that this could be the first time ever that this has happened and it's a negative return. So we have to keep our options open to where all scenarios are possible. And then this is just another way of looking at this. This is from FS Insight. And what this is looking at is the percentage of stocks below their 200-day trend line. And whenever we've seen the percentage of stocks below their 200-day trend line decline below 25%, in other words, when less than 25% of stocks on the S&P 500 are trading above, so less than 25% trading above their 200-day trend line, you can see here, with the exception of one time, back here in 2008, again, during the Great Recession, going back to 1990, there's a 100% win ratio. They were always up 12 months later. And how much up? It just depends on how much. But again, 9/29, so September 29th of 2008 was the only time that the percentage of stocks trading above their 200-day trend line was below 25%. So less than 25% of stocks in the S&P trading above their 200-day trend line. 2008 was the only time it was a negative number, 4.1% loss a year later. So with that all being said, I want to just kind of wrap up here with a couple just future possibilities. Again, looking at the weight of the evidence, the first question is, could this be the start of a true bear market? A big crash where the market rebounds and then starts to fall again, and we just see another leg down, and it could happen, right? It could be another 2007, 8, 9, 2000, 2001, 2002. One of our clients was asking about the Great Depression. Could it turn into something like that? I think the probabilities are low, but nothing is ever off the table. You can't think in black and white. You've got to think in probabilities and percentages. So could this be the start to a true bear market, a crash, or could this be an anomalous news-driven market, kind of like COVID, where you've got these things going on with tariffs? There's counter tariffs. It's just a big trade war, and the news from all the trade war events that are coming out, that it's causing a lot of fear and concerns even out of corporate America, and a lot of selling, because the way the stock market works is pretty simple. It doesn't really matter what PE ratios or PEG ratios or sales growth or earnings growth looks like, or quarterly earnings or estimates. None of that stuff matters as much as whether or not there is more buying enthusiasm in the market or selling enthusiasm in the market. When there is more buying enthusiasm than selling enthusiasm, prices must rise. And when there is more selling enthusiasm than buying enthusiasm, then prices must fall. And obviously, it goes without saying, this past week, and especially this past week, but the past couple of months, due to the trade war, tariffs, there's been a lot more selling enthusiasm than buying enthusiasm out of individual investors, the smart money, corporate America, and people are just extremely fearful right now. So what we're looking for right now is where the bottom is, when we can start in our trend following models, start getting back into the market aggressively and start taking advantage of the next leg up, because there will be a next leg up. In fact, if that's one of the most important things I say before I finish this video, is that this is temporary. It's always temporary, unless you think that we're going to crash like Rome and that our empire is coming to an end and that we're going to be eating our gold for dinner. I think that this is a temporary situation and things will get better. So just always keep that in mind. It's temporary. Other potential positives include a potential end to tax on Social Security income. Right now, provisional income limits tax Social Security at up to 50%, up to a certain level, depending on married filing, joint, single, and then over a certain level of a provisional income, you're taxed 85% of Social Security is taxed. That could go away. Well, there's talk about an end to tax on tips and overtime work. There's also talk about a deduction for interest paid on domestic vehicles. So if you purchase a car made in the U.S., that there might be a deduction on the interest paid there. And then we're also looking at potential lower interest rates, which would help school loans. It would help personal loans, mortgages, would add the potential for refinances, refinancing your mortgage that you paid at a higher rate to a lower rate. In January, it was only expected there would be one rate cut this year in 2025, where now it's expected the Fed's going to cut the rates 4 times. So if that happens, that could obviously help the market quite a bit. And to finish up, I had the opportunity to see Paul de Gelder speak back in, I think it was January, if I remember correctly. And Paul de Gelder was essentially a Navy SEAL, like a special ops in Australia. And he was doing a training exercise and swimming back to a boat. And all of a sudden, a shark comes up as he's swimming backwards and basically bites into his arm and his leg at the same time, and starts thrashing him around, pulling him underwater, and eventually it just rips a big huge chunk out of his leg. Most of his hand was ripped off, and basically he gets taken to the emergency room where they try to save his arm and his leg, but they can't. So at the end of the day, he had to lose his right leg and his right arm. And today it was amazing seeing him speak and seeing just, the analogies that can be joined between what he went through and what we're going through right now is that, he talked about how it was the worst pain he'd felt in his life and he thought he was going to die. And there was a moment when the pain, it got so bad, he thought he might give up, but he just kept pushing through. He kept swimming back to the boat. There's blood coming out of his arm, his leg. Obviously, that would attract more sharks, right? But he makes it to the boat. He pushes through. At the time when the pain was at its worst, he made it through. He got on the boat. He got to the hospital. And while he lost his arm and his leg, well, he ended up keeping his life, and he went on to train other special ops military in Australia, and he's been on TV, Shark Week. It's been just a great story. So. Now, another analogy I could derive from this story here is that if you do nothing, if you just go to cash and you just sit on your hands, the hardest thing to do is to decide when to get back into the market. So it really does help that if you're not a professionally trained technician, price analyst, it's really hard to decide when to get back in. And obviously that's what we're for. That's what we do here at Office. Second of all, if you stay invested in cash and you don't get back invested, then you can metaphorically, for those of you who are thinking this, you can metaphorically lose an arm or a leg in your portfolio that takes a really, really hard time to get back. The good thing about portfolios in the market and investing is that if you have a good strategy or multiple strategies like we do at our office, having tactical and strategic models that we put together in different weightings and percentages based on the client in question, how close to retirement they are, if they're already retired, then what you can do is you can regenerate your limbs. So when you lose limbs in your portfolio, you can regenerate those limbs over time and through prudent investment strategies. That's the first thing. The second thing is Paul DeGelder, one of the things he said was negativity is a vacuum in which nothing else can exist. Ban it from your life. One of our great clients reached out to me this morning, actually, as I was getting ready to record this video. And she said that she's hanging out with her daughter. She's, checking in on me, which is just so sweet. She knows the market's crazy, and so she's checking in on me to make sure I'm okay, which I'm completely fine. I'm completely fine because this is what I do all day. This is other people that do what we do in this business. We're comfortable with this uncertainty because we've seen it before, and we know how to deal with it. But she's checking on me to make sure I'm okay, and she says to me, "Just so you know, you'll be proud of me. I'm not looking at the news. I'm waiting for you to tell me what's going on." So that's what this video is about. It's to help our clients know what's going on. We're actually going to release this to the public as well. So everybody's going to be able to see this video. But, the point is, try not to watch too much of the news. Or if you're going to watch the news, be careful how much you watch because, again, negativity is a vacuum in which nothing else can exist. And it's really, really hard to have a great life because this is going to pass. Like I said earlier, this is temporary. And at some point here in the next, whether it's the next month, the next quarter, or the next year, this is eventually going to be over. It's going to be a blip on the radar. It's going to be another news headline that we talk about 5 years from now and go, hey, remember those tariffs? Remember that trade war? That's what's going to happen. It happens every single time. It's going to happen this time. And that's going to be the story in the future here. So with that all being said, I'll finish with one more quote. Baron Rothschild said, years and years ago, when Napoleon was fighting fighting Wellington at Waterloo, he got the news ahead of time using homing pigeons to find out that who had won the war. And he said, you buy when there's blood in the streets, even if it's your own. So I'm not saying, again, with our trend following models, we're still going to stay heavily invested in cash for now. But when it's time, we're going to start getting heavily invested in the highest rated, strongest, on a relative basis, the strongest investments, the playoff teams, the highest seeded teams in the tournament, so to speak, when this thing starts turning around. And meanwhile, our strategic models are going to stay invested in those same playoff teams so that we stay with strength, avoid the weakness on a relative basis, even if it's the cleanest dirty laundry, in case this market comes back super fast and we look back and so we say to ourselves, man, I wish I would have just stayed in the market. All right, that's all I've got. You want to get a hold of us for a second opinion on your portfolio? Please give us a call, shoot us an email, go to our website. There's a link there where you can find out more about whether or not we're a good fit. We'll set up an intro call with you and go from there. Otherwise, have a great week, stay positive, avoid the negative, and you know where to find us if you have questions.